I tried day trading, value investing, dividends, ETFs. Some of them were extremely risky, others were just painfully slow until I found one strategy that absolutely changed everything for me. And this was generating cash flow using options. So you can see at the top here, these are some of the results that the strategy has gotten. And like I said, this is all I'm doing now. It's just incredibly powerful. So you can see 6,000, 5,000, all the way up to 9,000 over here. And this is done on a balance that's around about 110,000. So we're talking about close to 6% a month here, 7% a month here. And it's just incredible. This is why this is just such an amazing strategy. And I'm so excited for you to learn it. So basically, all I do in my most basic form is I find high quality stocks. So I'm talking, Nvidia, Uber, high quality blue chip, not abstract little companies. We're taking high end, very well known companies, and we're effectively feeding their data into AI. So we're saying, okay, well, these are the results. Please analyze the news, do all of these things. And all it's doing is giving us a second opinion on whether this company is growing in the right direction, whether it's going to continue to be profitable, whether there's any kind of negative news or negative sentiment around it. And it's just giving us a better kind of investment idea with it. So this is an incredibly important part because even good companies can drop. So this is a really essential part in the risk management, and I'll make a video on it in the future. But for now, let's just leave it and continue, right? So the next thing we do is sell an option on these companies. So if you don't know, an option is just a contract. It's a financial contract, and it's really simple to do. And it's between a buyer and a seller. So in this case, we're a seller because we're selling the option. And basically what we're saying is, imagine I'm the seller and there's a buyer. And the buyer is normally an investor or it's a trader. It doesn't really matter. But they are paying a premium. They're paying income to us for that contract. And basically it says that the investor gets the right to buy a stock at an agreed upon price and date. Okay, so in the future, at some point in the future, if the stock price reaches a certain amount, they can buy your shares. That's the agreement that we're going in, and they pay for the right to do this. So it doesn't have to be risky. We're going to cover risk management right now, but a lot of people think, and this is my just idea, like I'm not 100% sure, but I know that when people first get into investing, they see trading, right? And they think, oh, buying options. And you can buy an option contract for really cheap. And they think that it's this amazing way to get rich. And then they get burned. So the sentiment around options is that it's risky. That's always the sentiment. And this is why I think it happens. But it doesn't have to be. I want to show you why. I want to show you how we manage the risk. So the first kind of big thing that I want you to understand is we set a limit on the price. We set a limit of how high the stock price can go before the other party can buy it. So here's an example. Let's imagine that we bought a stock for $100. So when we sell the option, we can set a limit of $125 in 7 days. So, there's only 3 scenarios. So scenario 1 is the stock price reaches the set limit. So it wiggles, it grows, it does whatever, it reaches 125. And if it goes above this amount, which is the agreed upon price, we said 7 days and 125. If it goes to 126, we sell it. But now, in this case, we get the money from the person buying the contract, and this is usually 1 to 2%. So in this case, it's say 1 to 2% of this $100 amount, or this $125 amount rather. And then we make money on the sale. So the stock is sold at 125. We bought it at 100 in this example. So that 25 is our capital gains, and it's a profit. So we make the premium, which is 1 to 2%, and any capital gains on the sale. So the 25 minus, so it's 25 times by 100. So just a caveat with this, you always have to have 100 stocks. So if we bought it for 100, it's 10,000. That's what the investment would be. You'd invest 10,000, and then you'd make 12,500 back plus that premium. So that's kind of how it would work. And all we do in this case is we just buy the stocks again, and then we do the process again, right? And you just keep repeating it over and over, getting the premium every single week, and that's it, right? And you're just growing your capital balance like this. So now scenario 2, because it doesn't always go above that price. So let's say 100, it's exactly the same kind of thing. It's still 7 days, but now the price wiggles and it ends up on 110. So in this case, the option contract is just worthless, right? It just expires worthless. You keep the money that the person paid for the contract. So the 1 to 2%, you keep it. And then we keep the stocks as well. So we still have the stocks. And this is actually the ideal situation, because effectively we just do it again the next week and the next week, and you just monetize the stock. I always think about it like real estate. All you're doing is just renting out your stocks every single week. And if it sells, you control the price, so it always sells at a profit. And otherwise, it's just the closest thing to free money that I've really ever found. So that's scenario 2. Now, scenario 3 that everyone's always worried about is, what if the stock price drops? The thing is it doesn't matter, right? Say it drops from 100 to 80. In this case, we still get the premium, okay? We still get that amount for selling the option contract, and the option expires worthless, okay? So you keep the stocks, and basically all that happened is if it drops a little bit, like this, 100 to, let's say, 95 or 90 or whatever, you just do it again. And again and again, because the stock price wiggles so much. It goes up and down and up and down, and you're going to be in profit, out of profit, in profit, out of profit. But historically, it just has climbed. That's why it's so attractive. It's like such a long-term perspective that you need to see, and then you don't really care if it wiggles. It's the same. I always use the analogy with real estate. Like if you hold a house, that house is wiggling in value as well. You just don't know it because you don't get someone to analyze how much your house is worth every single day, every single minute. You know, you don't have access to data that's readily and easily available. But that house is wiggling the same, but you just assume it's going up in value, right? We want to take a similar kind of stance in this. So if it drops a little bit, you immediately just go again and just sell another option contract. If it drops really low or it goes underwater, you've got kind of 3 options, okay? So you extend the lease term, i.e. instead of 7 days, you do 30 days. So it's a longer contract and you make more premium like that, okay? You make more money. And you just set it at either the cost price, the 100, or a price above cost price. Secondly, what you can do is raise the limit price that lets them buy the stocks. So I said in this analogy, it was 125. If you made that 140, let's say, you'd get less income or less premium, but the risk of it exercising and you losing money is just significantly less, right? So you could get to a point where there's a 5% chance of it happening or a 10% chance of it happening, and you could do that. Or if you're really nervous, you just don't sell option contracts on it at all and you wait for it to climb up again. So that you can also do, right? And that's perfectly fine, because a big factor is you need to like the companies. If you hold the companies and you like them, then it's the same difference, right? Like the stocks would be underwater if you weren't selling options on it anyway. So it actually just is irrelevant that it's underwater in that case. But either way, if you do one of these things, you're never going to lose money because you're never selling it for lower than the cost price. And also something that people don't realize is every time you sell an option, it effectively lowers that cost price as well. So you sell an option, you get 1%. Now your effective cost price is 99. And then you do another week and it's 98, right? And if you do it for a while, your cost price is actually being lowered. Okay, so let us jump to the final thing, which is what kind of results can we expect? And I touched on this a little bit earlier, but I see kind of 5 to 9% per month in good markets, in average markets 4 to 5%, and in bad markets 2 to 4%. So these are all subjective, because you could argue that now with the whole Iran war and stuff, it's quite a bad market, but volatility increases the premium. So if you got in and started doing this now, it's a good market, right? Because you're getting in at basement prices, you're getting really high premiums. If you got in now, I could see 5%, 7% pretty easily. So with a balance of 100,000, you could be making, 2 to 9,000 per month in extra income consistently. I've seen this over and over again with my own portfolio. So if you want the one-page version of the strategy that shows you step by step exactly how I generate $2,000, $5,000, $9,000 per month every single month using the strategy, then comment stocks below and I'll send it to you. Otherwise, thank you for watching. Please like and subscribe if you haven't already. It really helps me. I appreciate you, and I'll see you in the next video.